Well, it's
now
after
that
the
it's
fact,
happened,
right?
yeah,
It's
yeah, it's
after the
after the fact.
fact.
It's so easy to say that hindsight's 2020. And look, there are structural problems here, and we've talked in detail about a lot of the structural problems. Um, I there's no one stop solution here, and I think that's the biggest takeaway for me, at least, is there are band aids you can put on this problem. There are short term solutions. I think probably the most effective short term solution is what O'Hare mentioned, which is a reversal in rate policy. But then the
Yes,
question
rates would
becomes,
solve the problem, but then, you'd have some
yeah,
other
then the
issues to deal
question
with.
becomes,
But
do we
what
have
about the
the
next
question becomes,
cycle? What about the
yeah,
next
yeah, the
cycle? I
debt
mean,
cycle, but then we also have
either
the inflation problem, right? Like,
you've got to put some capital on. If you're having zero capital on these HTM, even AAA with volatility, you need risk based capital there, or you need to have
I
mark
don't
to
think you can
markets.
do the monetary. I don't think you can do the monetary. I don't think you can do the monetary policy calculus here effectively without knowing two elements of this that we don't know yet. First, what's actually the net inflationary impact? And I don't think you can know if this is going to be net
Nobody knows.
inflationary.
Nobody knows.
Yeah. We know, like, in theory, a bank collapsing is deflationary. That's obvious, basic macro. But, there's
I would
other
say that
elements at
going
play
into
here,
this
right?
space, 90% of people did not know bank
Yeah,
going under
okay,
was
that's
deflationary.
fair. Yeah, I don't want to say that that's just common knowledge, but look, I mean, if you've anybody with enough macro knowledge would assume that in a vacuum, um, a bank failure is deflationary. Here's the funny thing about banking, though, is you can't really look at it in a vacuum, right? Because it's banking, and I think the broader point here is what will be the fallout in credit creation. That's gonna be the tail end of this calculus that tells you if this is going to end up on the inflation prints on the plus side or on the negative side. That's really it. The fallout in credit creation, if it's steep, if it's dramatic, I mean, we've already seen credit creation
It's gonna be
standards.
terrible. It's not even just the banks.
Yeah,
It's the private equity firms writing down these stakes. VC firms writing down stakes by 80%. How much investing are they going to do this year? It's the CRE CLOs. It's the CMBS. How many new deals are they going to do this year? It's the private equity firms. How many deals are they going to do? And if they do deals, are they going to do it without debt and pay much lower prices? It's this huge circle. Student lending
And
securitizations. Who's going to
wages.
fund
Yeah, I
those?
was
And
just going to
wages.
say the
Wages,
labor
right? With
market. Yeah,
layoffs. What's going to happen there?
yeah, the labor market implication here, I think, is a pretty daunting one because when labor market gets tight, people start going to credit, right? And if lending starts to tighten, then what? Right? You have defaults on.
Then you spend
Yep,
less, and
and you have auto loan defaults, you have
then
mortgage
did you
defaults.
listen to Walmart's call?
Yep.
And Lowe's call? For the first time in several years, Walmart says, "Hey, we're not going to be increasing prices much," you know. And it's not that they can't. They probably realize that they don't have the ability to, given the demographic of people that shops at Walmart. Lowe's said the same thing. Lowe's said we're raising employee wages, because they didn't catch up to inflation last year, so that is positive inflation. But then when they talked about prices, they were talking about discounting, right? We're having difficulty passing price increases on consumers. Like, that's not inflation. That doesn't sound like inflation to me.
Well, yeah, and I think
Elasticity.
not going into too much detail, but obviously I think stagflation, right? Not talking about enough about wage growth in this sphere, and only certain sector focused wage growth. There's definitely some bias that hopefully there will be some rotation into other sectors where there is a focus on wage growth, that is kind of leading the front, if you would, before lending does tighten.
What about real estate? How come well, actually, I don't know about the rest of the country, but here in New York, even with the crazy interest rates and everything, real estate is really, really high. Things are not moving off the market as quickly. They're sitting longer, but prices aren't really coming down.
Yeah.
5%.
Prices
So one thing about
prices are
real
coming
estate,
down because there's no transactions, right? I mean, you
that's
gotta have
exactly right.
transactions, and that's
If you
Hey,
have,
we
if
got
you
Grant.
have,
We got Grant Cardone here.
oh,
Let's hear
Grant's
what
in
he
the
has to
house. We
say.
got real estate
oh,
guy. Yeah,
Grant's the real
Grant's in
estate
here.
guy. He can
There
talk
you go.
about this. If there are no
Yeah,
transactions and there are no deals, how are you going to see those prices fall? In San Francisco,
Yeah,
prices
but
are already
like,
right.
down 14%.
So when
well,
you
not,
talk
not
about
in New
shadow
York.
bank, yeah, you talked about shadow banking earlier. It was funny because this is exactly what's going on in in kind of the real estate market. There are very few transactions, so the spread between the bid and ask right now is extremely wide. you don't know what the bid is until it actually kind of materializes. So you can put your house on the market, ask whatever the hell you want. The reality is you're only going to get what the next bid is. And if the bid is 15, 20% below ask, then that's what it is. Your house is only worth what someone's willing to pay, just like every other asset. Right. And so the idea that real estate hasn't crashed yet doesn't mean it, it's like this invisible crash with real estate. Just because prices haven't been pegged yet doesn't mean that they haven't crashed. Right. There's a big distinction to be made there.
I will say that there's some big implications to interest rates going up, and the longer that the bid ask spread continues to widen, the more interest implication to whoever the holder of that construction loan. If it's new construction, I think that's an area that isn't focused enough about. Is a lot of these segments where you have builders, they weren't anticipating this type of. They had a variable rate at 4% to build a home, and it's at 7 to 8%, 9%, right? And they've held it for 3 months longer. Eventually, that inventory is going to rotate. And I think one be particularly interesting is you look at the DR Hortons, the Ryan Homes of the world, and you really start to think, okay, where's the focal point going to be for a lot of these builders to finally release inventory if they haven't already, to make the market a little bit more stabilized to reality?
And it's not just that. That's an acute point that's very important to understand. But the builders right now have been offering incentives to people, right? So the prices you're seeing on the homes, those are not the real prices. The builders are basically giving you interest rate. They're buying on your interest rate. They're giving you, 20 grand. They're paying your closing costs. So if you were to go and subtract the net present value of the lower rates, any subsidies, and paying your closing costs, and you were to take that out of prices, the actual prices that these home builders are earning is a lot less than what you see in the market.
And where does the appraisal normally come in at, right? Like if I'm going out to buy a home, 99% of the time, just magically, the appraisal normally gets pretty darn close to what the house is selling for generally. So I think this is a very good point. I mean, the buy downs and the rate locks, et cetera, that builders are using to incentivize is definitely a mechanism. But again, getting inventory off your books and not holding construction loans, at least for builders or GCs, or developers for that matter. It's a huge shift in psychology, right? Because we had free money for a while. A lot of builders came into the space, and I think it is definitely a market mechanism that's changing and likely going to be one that will lead to consolidation, the same way that Credit Suisse rolling into UBS will be, right? You find more efficient ways of doing business. Whether it's for the worse or better is kind of up for debate.
Somebody buying a
Here,
house
when
right
you,
now,
Raphael,
what
before you
kind of
jump in.
mortgage? If somebody's buying a house right now, what percentage increase do they find in their mortgage payments as opposed to them buying it like a year ago? Isn't it like almost
It's
double now
very
for the
high.
same amount of
No,
house?
it's
Wild,
it's
yeah.
it's not double. It's not double, but I could say that if you versus 2019, right, to today, with mortgage costs and the price of homes being higher, your mortgage payment is at least 50% higher, which is, given it's your biggest expense, is insane, right?
And that's probably on a national level, right? I think you have
That's
your
on a national level.
yeah,
In
Yeah,
certain
and
cities,
it's
it's
higher
it's
on
double.
regional
but
levels.
that's where the U.S. Residential real estate market is unique, right? And that's why it's so nuanced to try to measure the impact on the U.S. residential real estate market with these things, because we have the 30-year fixed, and the 30-year fix and people locking in the 30-year fix where they did in those years makes it different. But one comment I wanted to make, to what O'Hare said earlier, you made a comment, you said, just because the prices haven't been pegged yet doesn't mean they haven't crashed. And I was like, wow, you were saying that in reference to the housing market, but it's funny how that statement can
It
apply to a lot
applies
of
to
what we
everything,
talked about,
right?
huh?
Any
Applies to the whole
liquid
Exactly.
asset.
maturity problem
That's
as well,
exactly
right?
right. Yeah,
Right. I mean,
exactly right.
that is the central issue, right? Prices that haven't been pegged, but in theory have already crashed, and that's, I mean, that is the cornerstone of everything we're talking about today, which is, it's funny how it comes full circle.
I think it would be funny that Grant. I know we spoke about this a couple days ago, but the seller becoming more willing to finally let go of things as they're holding assets. I mean, large projects that most sellers have been extremely reluctant to sell off on, have kind of, in some cases, missed the boat, so to speak, to sell at a premium level. And a lot of foolish buyers perhaps bought at the top. But, I think he was bringing up a project where it was like, a $150 million project would probably sell for like 70 million today. The discrepancy of, the seller, it's almost like holding a really risky options trade, and you're swinging way outside of your pay grade, and you start recognizing that this bid ask spread is absolutely transcending into every sector, and I think that's a huge aspect that in the real estate market, until you get nailed down, I think pricing, until sellers really start to give up gains, those comps in certain areas of the country are going to remain resilient until they can't. And when they can't, it's going to be a pretty fast rolling snowball downhill.
So, like the situation in New York compared to 2008, 2009, I know we haven't had like a crisis like that, but I would have expected with interest rates soaring so high that things would be coming down here at a more of a rapid rate. Like in 2009, you can buy up shit for free. It was like crazy discounts everywhere. And here, people just do not want to take a haircut on their price. It's just
It wasn't
unbelievable.
2009.
Well,
That's
and
the
that's
thing
and
that
that's
is
right,
not
and that
true.
totally different.
It
And
was
that goes
2012 when real estate
and that
prices
goes
bottomed. It
yeah,
wasn't
and that goes
2009.
right. Yeah, and guys, that goes right back to what we said earlier, which was everything back then was not at zero. It wasn't starting from a zero rate. I mean, who is going to need to sell their house if they have a rate at even 3.5% for 30-year fixed? Nobody, right? Nobody's. So when you have mortgage rates at 7.5%, and you're sitting on a 30-year fixed at even 4, why bother? I mean, back then it was the other way around. All these ninja loans that had adjustable rate mortgages,
I
the
mean,
sites we were
in a vacuum, O'Hare, I think you're absolutely right, right? But the thing is, in an economic situation like where we are today, there's a variety of other factors that are influencing that decision. It
think
isn't
about how
always.
think about how many loans were done in 2007, 2006 and 7 that were 12-month adjustable rate mortgages, LIBOR based loans. Like that was the bulk of the loans that were being done. And those, by the way, were balloon payment loans. That's the difference, right? It's a whole different set of circumstances now. And I would argue even worse because the Fed is still raising rates, not lowering rates. And everything's upside down now, guys. The whole thing's upside down. So
You
it's
even
just
have that in the commercial space with the big lump sums, the takeouts. They finance it for 3 years, and there's a big massive amortization to the remainder.
And these runs, I guess, one of the things that isn't talked about, and there were several people that I've talked to that in '08, they had their loans called on mortgages and auto loans and stuff like that. So, to the stabilization of banks, I think people often forget that, like, just because you have a mortgage, right, doesn't mean that you're necessarily safe from it being called, right? It's still debt and it's still owned by somebody, depending upon where your loan actually sits. But I think that that's kind of a nuance as well that we can't like quickly overlook is, there's a buyer and seller on every facet of the market, and sometimes it's the taxpayer, like it was in '08, to bail specific instances of bad moral hazard, so to speak, out. But I think in this case, to Jay's point, that you've got a seller on the other end who, if they believe that their asset is worth more when it's held to maturity over 30 years on a fixed rate at 2.8%, nobody's going to give that up, right? It's very, very seldom. And if you do, the only trigger that I think could be a big issue is if you're refinancing, you got in at such a good rate, such a good home value, you start seeing a flush new relief of these refinancings in order to pay down other things like credit card debt that have a larger interest rate. So I think a rotation of the consumer psychology in over the next like 6 months is going to be super critical to understanding like how the next 24 months is going to play out.
I mean, at the end of the day, this was all knowable, right? I mean, raising the rates, like we said, if it was done over 3 years versus so quickly over a year, the minute you raise rates, the mortgage rates are going to go up. It looks less attractive to buy real estate. I mean, it sounds like at least in New York, there's this sort of last stand or hope, and I think that's going to have to be a factor, right? Is when they make this call on Tuesday, regarding what the rates are going to be is not just what the impact is to the banks and the bank books, but what's happening with the economy. If there's still clearly a demand in places like New York, of course, and I think that the prices are probably still staying where they're at because people can't say, well, why the price should go down, like look at the economy. But I think there is this argument of just the less attractiveness of getting into a house because someone doesn't want to pay a higher mortgage. And in a sense, it's kind of like the pain of like a little bit of the amnesia everyone's had, like, because last like 15 years, we just haven't had a higher rate environment. We've kind of been spoiled by the zero rates and the free money. So dealing with 4 or 5% is like a shock to the system. Some people, may not have been, they're now in their 20s and this is the first time they're like dealing with this, higher rates. And when it seemed like it was like 3% forever. So I think there's just this reality that's setting in, and there's a lot of unease. And I think that at some point or another, the Fed, I think, knew there'd be a little bit of this pain. What they didn't expect, though, was the banks themselves to be having issues with managing the interest rate risk. That I think has caught them off guard. And now this UBS thing, Credit Suisse, makes it a whole new ballgame. And I really believe they put out this floater, to see, hey, we're going to do liquidity lines. We're going to see if that settles the market down. But and someone was saying before, like, well, is this it? Is this the end of it, or are we going to call the end of? You have to remember, like in '08, there was like Bear Stearns, and then 4 or 5 months later, the IndyMac failure. Then a month later, Lehman. If there's some systemic thing that's happening right now, this could be over a period of weeks and months, and it could be accelerated by what we were talking about a few hours ago with like Twitter and the speed of information and where people start to see, where the next weakness might be.
Jason, I'm going to ask a stupid question, Jason. Why was it so hard? Why is it so difficult to find things like the issue with Silicon Valley Bank, the risk with Silicon Valley Bank? I know there's a bunch of people on Seeking Alpha that found that issue, but why many analysts missed it? Why did regulators miss it? Like, shouldn't it have been
Regulators
some?
didn't miss it.
Well, I
What do you mean
think
they didn't miss
and
it?
there was
I don't
early.
think
If they didn't
anyone
miss it, they
missed
would have.
it. It's
They knew
just that it
about
just
it. They
sort
just
of
didn't
like
do anything about it.
became a runaway
Exactly.
train
Yeah.
on
It
its
was.
own.
This was a failure to regulate effectively. It wasn't an inability to identify the issue. Not only were regulators in the Silicon Valley Bank offices, a year plus prior to this, but very, very cornerstone financial institutions like BlackRock were directly consulting and advising Silicon Valley Bank about the fact that they had poor risk management protocols. So, the risk situation at Silicon Valley Bank was illustrated well, and as it was illustrated well with Credit Suisse as well, right? Like, I remember when I mentioned this earlier, somebody commented in the comments and was like, "Oh, don't be disingenuous. Everyone knew there were problems with Credit Suisse." Well, of course. I mean, anyone who's been exposed to financial markets knows that Credit Suisse has been in the headlines for quite some time. That doesn't mean that all of these things happening within a week's period isn't concerning, and it doesn't mean that all of these things happening within a week's period doesn't speak to a bigger problem that could be rolling, right? It's different to identify what the core issues were at these institutions going back a year or 2 years. That's one conversation. And the other part of the conversation is, what's the thing that killed all of these banks? And that's deposit outflows. It's what killed Credit Suisse too. The Swiss National Bank said 10 billion a day in deposit outflows last week from
It's
Credit
fucking
Suisse.
insane. And how did these compare to the numbers? What were the numbers in '08?
I mean, and if you go back to '08 and you look at Washington
The big
Mutual,
bankruptcies were like not
that
even
was
close.
16.5 billion in, I think, 10 banking
10
sessions.
days. It was a billion
So
plus a day.
yeah, so 10 sessions.
But that's
And
great.
now
Hold
we've
on, hold on.
seen.
So, but that's how. Fuck, that's insane. That's crazy.
Yeah,
Why do you
Even
think that that,
Credit
that
42
Suisse,
billion
discrepancy?
in a day
and keep
at
in mind, Credit
SIVB.
Suisse is a known GSIB too. This is like a well-known, like, people know that Credit Suisse is a GSIB,
But why? Why,
despite
guys?
everything that was said.
How? Like, why?
If
Why?
you're
Like
a
in
private
Well,
'08.
you
bank,
gotta
It's
hold on,
panic.
if you're a
It's
Mario.
private bank client at
Mario.
Credit Suisse, you
But
think
we
you're gonna
saw.
stick around and
But
find
hold
out?
on, you
No,
gotta
no, guys.
understand.
But then this
There's
applies in whoever. Both your answers. Someone in Stock
There,
Talk gave me two answers, but the same answers apply in '08. Why
yeah,
is it
but
so
hold
much
on,
worse this time?
Mario,
No, but
because
this is the issue with the '08
there's more
comparison for
money in the
me, is that,
system.
yeah, I mean,
Okay,
more
there
money in
we.
the system. There are a lot of differences, but this is my problem with people keep bringing up '08, is that it doesn't have to be like '08 to be bad. That's a very resolute and logical thing to say. That there's this fixation, and we do this every time. This is like human nature, where
Yeah,
every time there's a crisis, we want to look at the previous crisis and say, "Well, it's different from the previous crisis because of
No,
X,
so
Y, Z."
I don't mean
Right?
this.
No,
I'm
I'm
just
not
trying to
saying that you're
understand why
saying it,
is
Morgan.
no,
so
but
I'm
why
just
my
no,
saying.
I was just saying, yeah, just the outflows name, and I see you jumping, but why the outflows so much larger this time around?
because there's
That's
more money in the system.
There's
Okay,
less
just look
friction.
at since the
Well, there's less friction.
pandemic alone, deposit growth was 35%. It went from 14 trillion to 20 trillion just in the pandemic alone because of all
There's
that
less
monetary
friction.
stimulus.
There's less friction and looser. I don't want to say looser capital control because that's not the right word, but there's less friction. That's why
And more
there's
concentration.
more concentration, less friction. I mean, it's so fast now. Like I did this the other day just to test it. Like I was just curious, and I have bank accounts. Sorry, at J.P. Morgan, and I also have bank accounts at Bank of America. And I test this the other day, and I mean, within 5 seconds, you can transfer a lot of money. Okay, it's just a couple clicks, and so it's a much different climate than it even was in 2008. In 2008, even it was a longer digital process than it is today, even to the extent where it was a digital process. Now you can even go to tiny regional banks. They have sophisticated digital processes. Within 3 clicks, your money's moved. That's why it happens so quickly now. It's not, again, the global banking system was asleep about this for the last 15 years. It was happening under their nose. Everything was digitizing, accelerating the pace of digital transfers. Everything was accelerating, and global banking community was just like, it's okay. They know, they're aware. The U.S. banking community is fully aware that there's $17 trillion in deposits that are sitting in accounts, and all it takes is a couple clicks for it to be demanded in cash. That's a
Yeah,
fucking
and that's one
huge
thing I've
problem.
been.
A huge problem.
I
That's one
also
thing
think
I've been.
the nature of the problem is very different from 2008 because this one is specifically focused on removing deposits, flight of deposits, and bank runs, whereas the other one had lots of other components to it. Where this is specifically focused on that problem, which I personally believe as a issue, this specific issue can snowball into a